Welcome to Market Monday from the investment team in the trust department at the First National Bank. We've got a few data points coming out over the next couple of weeks that have the potential to really move the market, and certainly lots of data points in between that have the potential to inform our view as to whether a recession is coming in 2023 or maybe early 2024, or the Fed is able to engineer a soft landing, which simply means, a rate hiking cycle that does not result in a recession. So let's talk about that for a second. That's been on the media quite frequently over the past couple of weeks. This soft landing scenario seeming likelier than not, according to the pundits. Well, if you look back into history, over 60 plus years, the Fed has been able to manage this one time. And yet there have been quite a few recessions that are linked to rate hiking cycles in that same period. So purely from a historical, probability perspective, the odds don't appear to be very great that they're going to be able to do it. Now, with that said, all isn't, off the table with that. There have been some extraordinarily robust economic reports over the past several months, including in the labor market that remains strong, probably being the most notable. Inflation is starting to come under control, being another notable. At least it's showing signs of coming under control. We won't say it's there yet. Talk about that in a little while. But, is the probability on the side of the soft landing? Probably not. We're certainly in the camp that's still predicting a recession later this year or early next. And the basis of that is just indecision in the data. It's not a uniform message that's being sent by market or by the economy. And when we look at it, last week retail sales came in at 0.2% versus a 0.5% that was expected. That means consumers are slowing down their rate of purchases. Essentially, retail was expecting sales growth of a 0.5%, only got 0.2%, a fifth of a percent. So that variance there shows a bit of a weakening in the outlook. And that's magnified by what happened with industrial production, which actually declined by 0.5% when it was expected to remain flat. So the picture here is you have slowing sales, or at least slower than expected sales at retailers, who then forecast lower demand going forward and then pull back on ordering from producers, who then pull back on production. And that can create a vicious cycle that culminates in recession. That's something to watch. That was the big thing last week. This week, this morning we got conflicting data. Manufacturing came in stronger than expected in its outlook. Services sector came in less strong than expected. So we're getting mixed messages here from that portion of the economy. Consumer confidence comes out later this week, and that is a key driver of consumer spending because the less confident the consumer is in the future, the less likely they are to spend, and that spending again is about 2/3 of gross domestic product growth. So we're watching it. We'll get information later in the week about real estate. Most important probably is the Fed rate decision, although that's not expected to be a market mover. 25 basis points is baked in. However, what's not baked in is the commentary that's going to come afterwards. So generally, at the release of that decision, they issue a memo and a commentary. And then the Fed chairman has a speech with a Q&A period. And during all of those things, there's an opportunity for market participants to get some insight into what the Fed is looking at, what it sees, and what its projections are for both the economy and the glide path for interest rates going forward. So that has the potential to be very market moving if the Fed appears to have a different mindset than what many of the market participants have been forecasting. Again, and they've been forecasting that soft landing. We're of the view that the Fed's likelier than not to come in more hawkish or aggressive toward inflation than people are expecting. And it remains to be seen whether or not that happens. But certainly the inflation numbers that came out and are coming out tend to indicate they have to be. GDP revision comes out on Q2 with being revised down to 1.8 is the expectation from a 2% when it was initially reported. And we get information on durable goods again. We'll get more information on the labor market, more information on income and spending, which is key, again, toward trying to figure out what's happening with future demand, consumer spending. And here we have the PCE deflator. This is what the Fed tends to look at for its measure of inflation, and why we said just a moment ago that we're expecting them to remain hawkish, because the PCE core deflator is one of the Fed's key items that they want to look at are we getting inflation under control? And that's expected to show 4.2% on a year over year basis. Yes, that's lower than the 4.6 that it was at the last reading, but that's still well above the 2% comfort zone that the Federal Reserve says they're targeting, and implies that they have to continue to take action, probably beyond what's being talked about on the media right now. We get more sentiment indicator, and that'll round things out. Labor market, more market information about demand and the durable goods. In terms of markets, what does all this mean? Because we've just talked about an unclear picture in the economy, a little bit of muddy water, yet the S&P 500 has been doing nothing but march up since the end of May. It broke out and continued up, even in the face of any negative news report that would come out. The market would just simply not go up, or maybe continue to go up just with less rapidity. Or, we'd get good news and the market would rocket higher on a day. And this is what we call bull market behavior, and suggests that there's a lot of strength in this market. And this is coming off of 2022, which is where we start this chart, which shows a bona fide bear market in stocks that stabilized. It hit a bottom in October last year, and then trickled up, and then stabilized, and then started moving higher from there. And this action, the market is a discounting mechanism. It's the collective forecasts of all the market participants, and therefore it tends to look out further than the immediate future. We think maybe 18 to 24 months plus is the general outlook for these for the indication from the market. And so if you look back historically, let's say we did get a call that now where the economy is moving toward a recession, we're not convinced that the equity markets are going to turn down on that news. In fact, if you look back in history, markets have tended to bottom in advance of the official calls of recessions. So it's entirely possible that the market's bottomed, and then we'll get that call later, but the bad news has already been factored into the market and worked out, and the market can experience maybe a minor pullback and continue to go up. Sure, we could, in fact, see another bear market. It's just not as likely based on a read of history. So we're not too worried about stocks. And here's another reason we're not too worried about stocks. We're in the middle of earnings season. Just under 20% of the S&P 500 companies have reported. And by and large, the surprises on sales have been positive, with the exception of materials, energy, and communications. And, on earnings, almost across the board, with the exception of materials, it's been stronger than expected. These are the surprises. But let's be fair, only the financials have reported a significant enough amount of their members for us to really say what's going on, or estimate what's going on in that sector. And that looks very strong. But with financials being the lifeblood of the economy, we think that these results bode well for the rest of the index. And so, the action in the market remains strong, even though there's some doubt as to whether we're going to see a recession or maybe that soft landing. But either way, we're less convinced that that really matters in the grand scheme of things. Now we have an inverted Treasury yield curve where the 2-year rate is higher than the 10-year rate. And that's been a persistent condition for quite some time, and it does tend to augur and occur with recessions. So we see another indication here that potentially those forces are in play, but these yields are very strong relative to what they have been. And if you go to the corporate yield curve, where most of our investor base is, you'll see that rates are very, very good. Yields are good for the retail investor. You've got 2-year paper over 5%, 1-year paper is 5.5%, 5-year paper is 4.8%. Yes, this curve is mildly inverted as well, but these are very strong numbers for income investors. And you want to have a fixed income portfolio for most portfolios in order to reduce volatility and provide that income. These higher rates are very good for that income. So coming back to the S&P 500 to round things out before we close, the market was a wild ride in 2022. It's been a little bit less so, and volatility has dropped off substantially, and the market's begun to climb. And there are a lot of people saying things like stocks are overvalued. Maybe it's time to take profits in the face of an inevitable pullback. And what we would like to caution is it's rarely a good idea to make changes to a really good long-term investment plan based on whatever is happening in the short-term horizon in the markets. And to kind of illustrate that point, we're going to go back, like we always do, 20 years. Our time frame when we invest in stocks is 5 years, 10 years, 20 years. And when you look at this chart, here we have the 2008 financial crisis, which was among the scariest that history has seen. And, there were a lot of people thinking that the whole system was broken financially here in the United States. We have a very bad bear market in 2018 that culminated in one of the worst Christmases, if not the worst Christmas in market history. We have the COVID crisis where we thought the economy was going to break. And then we had a full-blown bear market for a year in 2022. These events were very frightening to go through, but what if you got out down here and it took you until here to get back in, or maybe never at all, and maybe you were hurting because you sold down here? We don't want to make those changes to the long-term plan. We know that we're going to experience bumps in the road over the long-term horizon, but we also know what the general slope of this movement is, and that's an appreciation. And so we want to take this long-term view as an investor. If you have questions or concerns about your portfolio, we'll be happy to talk to you about those. We hope you've enjoyed this video. Thank you. Have a great day.